Welcome to Electrified. It's your host, Dylan Loomis. A few quick things before the interview. So, Loup Funds is a tech investment firm, and they do have a Frontier Tech ETF that you can check out at loopfunds.com. Gene Munster is the head of research at Loup Funds on CNBC all the time, but I chose him because he's a very rational and unbiased thinker. He definitely understands the Tesla story better than many analysts, but he's not just some Tesla superfan. He's also very aware of the challenges ahead for Tesla and does a great job communicating those. In case you wonder why I don't push back on certain points, it's because when I have a guest on, I just want to ask the questions and let them talk. You guys hear from me plenty. And lastly, you guys know I never ask for likes early in the video, but today I will, so please like the video before you forget, so that in the future we can bring on more great guests just like Gene. Enjoy the interview. So Gene, I guess let's just get right into this then. First and most importantly, what is going through your mind when you're listening to Gordon Johnson debate your points on CNBC?
There usually are a couple riffs, and one of them that's less important is there are times that Gordon says some things that I just think are off base, and I'm thinking I'm doing like fact checking in my head. That's periodically happens. But there is another thought when he's giving his views and I'm disagreeing, thinking in my head that I'm disagreeing with it. Is a wise person once told me that whenever you're having a conversation with somebody and they have a different view, keep in mind that they could hold a card that says that they are right. They can pull that card out at any time and lay it down on the table. And it really just keeps the whole conversation in check for me, because Gordon could be right on this. It's still a lot to be determined about how Tesla plays out. And I remember that. And I want to be respectful to his opinion in case that happens.
I like that attitude. And he's definitely passionate. You have to give him that.
Right.
So moving on a more serious note, we're moving into a very new macro environment relative to where we've been. So what general message do you have for investors or clients of yours?
Well, the general message is that we're not hit the bottom yet. And part of it is that all the dynamics in the market still haven't played itself out, we think, on the downside. And so we really go back to a conservative approach here in these markets. And it's nice to see some of these rallies that we have experienced. But at the end of the day, what matters is what the Fed is going to do relative to inflation. What matters is what's going to happen related to commodity pricing. And as the Fed navigates that, also with the easement on the balance sheet, all of those factors, we believe, are going to weigh on the market over the next 3 to 6 months. And eventually, we think that they're going to cause some form of recession. People are pretty mixed on whether that's going to happen. We would expect to see some of that. And when companies are reporting their June quarter, the retail numbers so far have been pretty good. But we do expect that we're going to see hints of a recession, and the market doesn't like uncertainty. And so the first piece we tell investors is be patient. The second piece is be opportunistic, is that doesn't mean that you have no exposure. You should have exposure to frontier tech, to these companies that are changing the world. And most importantly is that 2023 is setting up to be a great year for tech. And for a couple of reasons. First is that once the recession actually starts, if that does happen, usually the markets start acting better, and where there's been risk off, risk on comes back on relatively quickly. So that's one factor. A second factor is a lot of these tech companies are really working off these difficult comps that they had, or the benefit that they had over the last couple of years, and really resetting their comps this year in 2022. And so we're going to have easier comps basically in 2023, and the market likes investing in companies that can beat their numbers off easy comps. So to put those two together, we think 2023 is going to be a great year, and you really want to be positioned. It's not investment advice, but our view is to be positioned in the back half of this year for a good 2023.
Okay. Speaking of valuation, so moving into this new space of quantitative tightening and interest rate hikes, that's a stark contrast to low interest rates and easy money, if you will. How does that change how you think about valuations for some of these companies like Tesla and others?
It has an impact. One of the tools that we use, we call it the reverse DCF, where we factor in what kind of growth is priced into companies. And that factoring that growth is impacted by the discount rate that we use. Also, you think about the cost of capital. The cost of capital is plays into a DCF, and the cost of capital, of course, is impacted by what the interest rates are. And so there's a risk component of it, and there also is just a market component around interest rates. And to answer it fully is that when we think about Tesla specifically, the discount rate that we've used has inched up. It's inched up from 10 to 12%, and that is based on what their cost of capital is, plus a little bit of a risk premium in there, and so it has impacted it. I think that when we think about the chapters about discount rates and interest rates and what the Fed is doing and not doing, think about those. Maybe the pages of the book is a better example. Is that the chapters will usually have a subtitle to it, and the subtitle is "Don't Fight the Fed." And in the case of what we're seeing here going forward, the Fed is going to have an impact on these discount rates, and that's of course what we've seen happen to tech stocks. And my question, of course, is how much more is there to go around what's impacting these discount rates?
Mm-hmm. So when it comes to these interest rate hikes, how much of that do you feel that the market has priced in at this time?
I think that the worst is over, and if I was going to put some, numbers around this, I think 80% of the pain has happened. I still think that there is 20% to go, and that was kind of my earlier commentary about trying to find the bottom of this. I don't think we're there yet, but I do not expect another down 80%, for example, in some of these companies. That does happen, by the way. I give you examples of companies that have gone through that in the past week. They're down 80%, they're down another 80% in the following week. But to answer your question is, I think that we are through the worst of this, and I think that there still is more. The market does a wonderful job of pricing in risk, unless it comes more quickly. And in this case, it's come quickly, and so we've had more risk priced in, but we're not there yet.
So is there a single catalyst that you would say you're looking for to signal a type of bottom, whether it be, signs of deflation, prices coming down, or a overall market valuation metric? Is there something that you're watching personally?
If you're going to boil it down to one set of, I guess, one key metric, it's commodity pricing. And commodity pricing have some of the largest impacts on what the rate of inflation that every day that we all feel. And so I think that is the first input, and then the output comes to what the inflation number is. So if you can watch everything from orange juice to oats to lumber. You can watch the pricing of those, and as soon as they kind of inch their way down, I think that is going to be a base mark. If we went and recently looked at a group of 5 of those from where they were in the spring of 2020 to where they are today, that group is up on average like 120%. That's too hot. It probably is going to come down to up 50%. And so if you really want to get a sense of when this ends, is just keep an eye on lumber future contracts. LBN 22 is what you want to look at today. Those are the July lumber contracts. Wait for those to get down to around 500. It's kind of in the high 700s right now. And I think that at that point, we're going to start to see some broader easing in commodity prices that are going to find their way through. And of course, that's important because once we have seen some of that stabilization in price, investors are going to start to relax, because then some of the unknowns around future interest rate hikes become more known. We're not going to get surprised by a 50 basis point increase, for example. And the removal of that unknown, I think, is going to be a positive for the market. But there is a way to actually navigate this. One final thought: everything that we just recapped there, I think that's generally the market thinking. So it wasn't an original thought, but I do believe that's the key metric.
Okay, that's good. I like that. So let's talk about PE ratios for a second. There's much discussion in the Tesla community about this. So do you use them still in this environment? And if so, and you had to pick one, whether it be the trailing 12 months or, a future fiscal year, how do you kind of think about PE ratios in your valuation of a company like Tesla?
When you think about transformative tech, you have to stretch out to a couple years out. Think about what the PE is going to be in 2 to 3 years. And that's where a lot of the the controversy comes with investing in some of these emerging companies. And where I think of it in relation to growth too, that does matter. It's not just PE. You have to factor in some level of growth. So I think that a PEG ratio is relevant here. And of course, maybe to say it in a more plain English, is that I'm more comfortable at paying a 35 times multiple on something a couple years out if I think it's going to grow earnings at 40 or 50% versus pay 35 times for a company that's growing earnings at 5%. And so that is, it is important. It is a rift on this reverse DCF that I talked about. But ultimately, I think that is where a lot of these companies have burst. The bubble has burst. It's been just the lack of the lack of earnings, I think, has really caused the collapse of some of these valuations. And it's just a good reminder, is it matters how much money companies make.
Mhm. So what companies would you be comparing Tesla to? Some go to the traditional auto, some go to the tech companies, some are in between. So where do you find yourself?
Well, not surprisingly, I find myself on the tech side of things. I do not own a Tesla. Tesla is a religion, and I do not. I do my best, even though I'm impressed by their products and their prospects. I do my best not to attend whatever their religious ceremonies are. And at the end of the day, is I think that this company is in a great spot relative to what I think is becoming a tech company. And I think that kind of the well-traveled road that your listeners are aware of is just this debate. And of course, on one side, we have a group that says that traditional automotive is going to catch up. They make cars for a long time, and they're going to create enough competition and start to eat away at Tesla's market share. And that ultimately the profitability, most importantly, back to earnings, the profitability of Tesla is going to mimic more of a traditional auto company. I disagree. I think that what is happening in automotive is a wholesale switch out. I think that it is. I think that it's a step from reality so let me say it in a different way. It's accurate to say that building a car today is not building a car the same process, same methodology, same component, same profitability segment as what traditional automotive. It is true that people get in these devices and they move around, but from my perspective, this is purely a tech company. That doesn't mean tech margins can go up and to the right forever. There's a lot of tech companies that were really profitable, that were ahead of a big curve, that ended up getting bamboozled. And I think that that doesn't make Tesla in a great place, but I do think that history is going to see this company firmly as a tech company, and that debate will just ease away in time.
That's always why I've really enjoyed your analysis, Gene. You seem very rational and level-headed, which is something I, can definitely relate to. But when it comes to those PE ratios, looking at them, should investors be expecting some level of compression in this new macro environment? So rather than comparing PE ratios to the historical over the last decade, now that things are, changing significantly, should there be some level of compression expected?
There should, and it does have a near-term negative impact on Tesla shares. I think that I talked about we're not at the bottom. I still can see some hand-wringing. There's other factors, I think, from a high level that can work against Tesla stock in the next few months, which we can talk about. And so, yes, I think that investors need to factor in a more rational. And then the question is, what is the right PE ratio? And I'm 51. When I started in 1995. Just because I'll take an Elon Musk principle, just because we did something in 1995, we probably should do it different. This is a case where we did something in 1995, and I think it still applies today. And that is that, as a general rule, your earnings growth rate should loosely mirror your PE ratio, your forward PE ratio. And so I think that does matter. And I think companies that are gaining market share can get a little bit more on that. Coca-Cola, companies that are staples, Coca-Cola, Clorox, those companies grow at 5% and trade at a 20 multiple. But I think when it comes to tech, just generally think about whatever their true earnings growth rate is. Now, I'd say that's for the next 2 to 5 years, and then put a little bit of a premium on it. But we're not going back to 150 times 3 years out earnings for any of these companies.
you mentioned the peg earlier. So some people in the Tesla community will say just throw out PE ratios altogether and just focus on the peg. So what would you say to that cohort?
I think PEG matters. I think that what you pay for a company relative to its growth prospects does matter. And so, in the case of Tesla, I just kind of quickly think about this is they're probably in 2024 going to earn, my guess is $21, which puts it at right around a 35 PE. On it's a couple years out now, and I think they'll probably grow earnings that year at 40%. So when you put those two factors together, it says that the PE multiple should probably be more like 50, something like that, or 45. It feels like, or at least over the next 1 to 2 years, it's undervalued. Again, I think that there are some headwinds to the stock that are probably worth mentioning, but that's how I think about PEG. I think it does matter. I think growth does matter, especially in tech. And there's a very simple principle, which in tech is this will hopefully make and save you a lot of money, is the principle that if you're not growing, you're dying. And if you're dying in tech, there's really is no such thing as a value company when it comes to tech. Just ask Yahoo investors 10, 15 years ago. It just doesn't happen. eBay investors, you got to be growing, and that's a good principle. So growth does matter when it comes to valuing these. Therefore, the PEG matters.
Mm-hmm. So I know Loop is very big into AI and robotics. So how are you guys thinking about valuation when it comes to Tesla and full self-driving and robotaxis in the future? How do you think about that today?
We're really not factoring much of it in when we think about the opportunity with Tesla more broadly. When I think kind of 5 years out and think, again, not an investment recommendation, but my belief that this is ultimately a $2,500 stock. It's based on a multiple, mostly driven by just the underlying auto sales and the energy business. And I think when the auto sales obviously have an impact from FSD and that component, but it's not the adoption is still relatively low. The percentage of people that select those options is still relatively low. So we're still in the camp that is an additional growth driver. I would put what can happen with FSD. I think what insurance. I think Optimus. I think that all three of those are in a camp where this company could be a lot more, and this could be also the punchline to a joke, what I just said. That's why we don't put it in the model right now. It's because this is still so far out there. All three of those, even though they're two of the three have started a little bit with insurance and FSD, but I think collectively they're still far enough on the horizon that I'm just not comfortable underwriting that from an investment perspective, and hope that they get there, because if they do, that 2,500 base case is going to be conservative.
Yeah. Yeah, that seems to be the case with most of the street. Just, they're aware of it, but, they're not really modeling it because you can't. And that is definitely understandable. But let's say Tesla does solve for full self-driving, safer than a human, later this year, like Elon has predicted. Have you looked into what the story might look like from that point to getting to robotaxis? Like how long it might take, what the regulation might look like, what shoes have to drop for that to happen?
We definitely think about it. The first input is to take what Elon is saying and then divide by 2. And I'm not sure, or multiply by 2, I guess, in this case. So let's say it's end of this year. I forget what his latest commentary is, but we do think that they are going to be one of the first. I think Waymo they've done some impressive things. What they showed at the end of March, what they're doing in San Francisco. It is more of a level-headed kind of experience versus probably like a buck and bronco when you're doing some FSD right now. But to answer your question, I think that you should think about from a consumer standpoint and from a regulatory piece. It's not going to be a light switch where we're going to flip on. They're just going to continue to add different features, and regulators are going to continue to increasingly be more comfortable at okaying those features. And what I think is an underlying trend around regulation that's going to help FSD is there's full self-driving, which has features of kind of sitting back and let the car drive itself, but there also are new features that are embedded in FSD just around safety. And those are undeniable. Like every car needs to have these advanced safety features, advanced braking features, and we're still not there yet. And so I think that from a policy standpoint, I plead lawmakers to really embrace a better technology for safety in cars, and I think that that should pave the way for a more favorable regulation to allow FSD. And then to answer your question, you got to have the technology work, and so that probably kind of puts it sometime in 2025 when robotaxis and FSD really starts to matter.
Now, to most of the analysts that you talk to, are they thinking about, Waymo and Cruise and some of these others in one bucket in having this bifurcation because they're mostly geofenced, they're going to be location specific, whereas Tesla's approaching it, from a almost put anywhere, at least starting with North America type of approach. Are they weighing that differentiation, or do they just think it's, kind of all one right now?
It's more the latter. I think it's just, we have eye candy on both sides of the aisle, and I think people look at that, investors look at it, analysts look at it, and try to make up their mind who they think has the most substance behind it. And there's of course a lot of polishing around the things that we see. That's what I like about Tesla is that they throw FSD out in the wild. It's the real. You're seeing the real thing when you see some of these other videos. Just the more pragmatic side of me wonders like how much of it has been touched up. And so I think that to answer your question, I do think they put them all in the bucket. I think there's another piece to this too, which around regulation and getting Tesla out the door. I think that this holy war around LIDAR, it just seems silly to me, and understand why Tesla has the perspective that they have. You look at what a Waymo vehicle looks like. It's my opinion, it's ugly. And I'm not saying Teslas are great looking cars. I'm just saying the Waymo is ugly. And I think that Tesla is eventually going to be forced to have some form of LIDAR on that. And as strong as Elon has been, that they don't need that. Keep in mind, he changes his mind. Pretty easy to find examples of that. And so I think that eventually that's going to be an important a step forward, because I think redundancy is important, and I think LIDAR does improve the safety. Also, I think digital radar, which is something that they have pulled out, is something that eventually gets added. So I think that the safety suite's going to get amped up, and that will be a good leading indicator of when we're getting ready for prime time.
Is safety your biggest argument for why you think Elon will change his mind about LIDAR? And I guess to that point, have you given any thought to the dual input issue that's mentioned a lot? So like part of Tesla going vision only is because some of the other input from, whether it be radar or sensors, it has to make a decision which to trust. And Elon just thinks it's easier without some of those extra inputs. So how do you think through stuff like that?
There's the first principles, there's a technology view, and I would agree with Elon. And then there's the just practical standpoint of getting average people comfortable on adopting these technology and getting regulators comfortable at making them available to us. And I think in that case that you don't have to have LIDAR, doesn't have to fit hand in glove with the overall FSD. LIDAR could just simply be a safety braking system that could sit as a wrapper, a redundant wrapper. I feel more comfortable when I'm on an airplane when there's two engines. I think most consumers would feel more comfortable if there's that extra set of layers. And that's, this is a period where we're going to be experimenting over the next 5 to 10 years about what's actually needed. And I think as it stands now, redundancy is important, and getting the world really to embrace what I think is just needless loss. I mean, it is horrible. With some we don't think about, but it is 40,000 people lose their lives every year, and car wrecks, and it just seems like it's so like there's technology out there. So I think I'm okay with regulators pushing back on Tesla, saying get LIDAR on there, get digital radar, get one of the two. You can't just go by cameras alone.
Mm-hmm. Sure. So let's shift gears a little bit. How long do you think Tesla can increase deliveries 50% a year?
I'm surprised they've, as optimistic as I am about Tesla, I'm surprised they've kept it going at the pace that they have kept it going. But to answer your question, I think for a couple more years, and that would be just spectacular. But I think once we start to get into 2024, maybe 2023, but by 2024, we should start to see the law of numbers starting to catch up to those growth rates.
Yeah, I think it's 2026 where it starts to be like over a 3 million car per year jump, which would, obviously require a few more factories and things like that. What would you say is Tesla's biggest threat over the next 3 to 5 years?
Threat in terms of the company or the stock, or both?
Let's both, yeah.
We'll start with the company. Biggest threat to the company. They've done a great job of recruiting talent. I forget what the number was they recently announced, the number of people who have applied, but this is a talent race. And I think the greatest threat is Elon Musk is the most popular person in the world, most famous person in the world. Incredible, the spectrum of people that can relate to him. And I think that includes employees. And I think that the biggest threat is Elon decides that it's time to kind of move on, and whichever that might be, whichever shiny thing he goes for, and that somehow some of the brain trust, they're just not able to add as much. And the way it would present itself, this is like atrophy. It would take years for this to happen, but just products start to slow down. This does happen to companies. Innovation starts to slow down. They lose people, lose top management, that kind of that piece too. That's probably the biggest threat. I did not say competition was the biggest threat. I don't think that traditional auto is a keep yourself up at night threat. I probably stand in a smaller group that believes that. I think most people believe that they're going to get their market share eaten away. Obviously, their market share is going to go down in EVs just with the growth in EVs overall. But I do think there is, when it comes to the stock, just shifting gears, I think there is a threat that basically there's two forces that come into play. One is that component costs keep inching up. And then what Tesla's done a great job of course, is raising prices. And they're able to do that because even though when they raise prices, they still have the best car. Again, don't own a Tesla, but I think they have the best value for an electric vehicle out there. But if there is a chance for traditional auto just to have more vehicles that are electric, enough where people have some affinity to a brand, and it's not about just the best value for your dollar, tech value for your dollar. It's about some emotional pull to whatever. Pick the car, Ford F-150, and there's an emotional pull to that. And the way that impacts the stock is that it keeps their price increases in check. When you start to have perceived competition, even though they won't probably necessarily gain market share, it takes away some of that capacity for Tesla to raise prices to offset some of those component costs. And so the way all of this plays into the model is automotive gross margins start to decline. Mm-hmm. And that would be a big deal because earnings matter. And if that expectation went from the low to mid 30s to the mid 25s kind of over time, I think you'd see a more rapid compression of Tesla's multiple.
Mm-hmm. Tesla in China, they seem to be expanding there still. Do you or do any other analysts, that you've talked to have fears about this, about their reliance on that market? Or, obviously pros and cons, but which is more, I guess, for you guys at this point?
It's a slippery topic. I think that China has, it's pretty clear China has ambitions to do more when it comes to Taiwan. I think that they have ambitions to really do what a lot of countries are doing now, which is turn inward. And we've had this wonderful last 30 years of global cooperation. I think we're moving in a different direction. And how that impacts Tesla is, I think that, they're going to do a lot of manufacturing outside of China, but I think that piece gets impacted, that growth piece. It's something that, as we think about that growth numbers, those 50% growth numbers, I do worry, despite the massive opportunity that China is, I do worry that there's some geopolitical backfire that Tesla is going to be one of the first companies that is impacted by it.
Okay, interesting. So getting close on time here. So I'll ask you one last question. So you came into the year, I believe, with like 70% of your portfolio in cash. I was watching your interview with Rao. So how are you going about deploying that capital into this environment? Like, I know you had mentioned valuation metrics, but if you could share a little bit about that, that'd be great.
So we have deployed, I think we're somewhere around 50% now, might be a little bit more than that. But the way we're still sticking to this principle, we're trying to get it right. We're trying to get the timing right. And it is a piece that keeps me up. To answer your questions, we're deploying when companies that we love hit a threshold, which is based on our reverse DCF. And so we have a hit list of it's below 50 companies that are on there that we would buy on a, Fed says something, market's down 10%, we'd be buying there. And then we have alternative plans that what if we just wrong? We could just be outright wrong. Maybe all the negative news is priced into it. And we also have a mechanism where if we're wrong, that we can add as the market stabilizes going up.
Okay. And your $2,500 price target for Tesla, is that how far out?
I like to think of it as 3 to 4 years out, maybe 5 years. It's out there. It's not 10 years. It's not 2 years. It's not investment advice, but that's how I think about it.
Gotcha. Well, Gene, I really appreciate you taking the time to hop on. We always appreciate your insights. So thank you.
Love everything you're doing too. Thanks for having me.